Welcome to Iron Financial, the forge where we hammer out market weakness to build a stronger portfolio. Today, we are putting Westrock Coffee on the anvil. The company just dropped its full-year numbers, and the headline is, well, it's explosive top-line growth. The market is absolutely buzzing. But growth built on what? At Iron Financial, we don't get distracted by a shiny exterior. We stress-test the foundation. Is this company built on solid rock, or is it actually just shifting sand? The question we have to answer is simple, but it is absolutely critical. Is Westrock Coffee a high-growth titan in the making, or is it a brilliantly disguised value trap just waiting to crumble?
Okay, let's dive in. We're going to hammer this thing out in 5 stages. First, we'll forge the bull case. That's the powerful, compelling story the company really wants you to see. Then, it's my turn. We're going to look for the cracks in that armor. After that, we go under the hood. Exactly. We'll drill down into the balance sheet, inspect all the nuts and bolts, and of course, analyze the valuation. We'll wrap it all up with the final Iron Financial verdict. Let's get to work.
Let's start with the bull case. And make no mistake, the numbers here are doing some seriously heavy lifting. Whatever else we discuss today, you absolutely cannot ignore the sheer force of their sales engine. This is what's getting everyone's attention. And you know what? It's for a very good reason.
Just look at this, a nearly 40% increase in net sales for the full year. That's not just growth, my friends. That is an aggressive, full-throttle expansion. They are clearly forging a massive revenue framework. In a market this competitive, that kind of momentum is incredibly difficult to achieve, and it signals that their products are in demand and their strategy for market penetration is, frankly, working.
And it's not like they're growing from some tiny, insignificant base. They hammered out $1.2 billion in sales. This is the kind of top-line momentum that makes Wall Street sit up and take serious notice. You have to understand, a billion-dollar company growing at a 40% clip is a rare beast in the wild. So, what's next on their roadmap? Let's hear it from the man in charge.
Okay, this quote from CEO Scott Ford is absolutely crucial. He's telling the market that the heavy construction phase, the really expensive part of just building out the infrastructure and grabbing market share at any cost, is over. Now the blueprint shifts to optimization and profitability. He's laying the groundwork for a pivot from pure brute force growth to smart, profitable growth, and their outlook for the coming year really reflects that newfound confidence.
And this right here brilliantly illustrates their confidence. They're projecting anywhere from 29% to 44% growth in adjusted EBITDA for 2026. Now, for those of you who might be unfamiliar, EBITDA is a key metric for understanding how the core operations are performing because it strips out some of the accounting and financing decisions. This projection is the central steel beam of their entire bull case. It is their stated public path to future earnings power.
And listen, this isn't a one-time fluke. The data shows a very clear pattern. They have consistently, repeatedly beaten revenue expectations. I mean, look at Q3, a massive 25% beat. 4 of the last 5 quarters, they've delivered more revenue than the analysts on the street expected. This demonstrates a clear pattern of performance. On the surface, the structure they're building looks incredibly solid.
A pretty facade, maybe, but as we always say at Iron Financial, we're here to check the plumbing and the foundation. All that impressive revenue, all that talk of growth, it all raises one absolutely critical question that every single investor needs to be asking themselves.
Exactly. For every single dollar of revenue they bring in through the front door, what does it actually cost them to get it? Because a beautiful, rapidly expanding building that is losing money every single day isn't an asset. It's a liability just waiting to collapse under its own weight. So let's look at what's really happening behind that billion-dollar revenue number.
And here it is, the first major crack in the foundation. While they were out celebrating that $1.2 billion in sales, they were bleeding cash out the back door. A net loss of over $90 million for the year. And what's truly alarming here is that this is worse than the $80 million loss they posted the year before. This is an improvement. They're digging a deeper hole while trying to build a taller building. That is a recipe for disaster. And their margins tell the entire story in just 2 numbers. An operating margin of -3% and a net margin of -8.5%. This means their core business operations, the actual act of selling coffee and beverage solutions, are fundamentally unprofitable. Before they even pay a dime of interest on their debt or their taxes, they are losing money. This isn't a sustainable model. It's just not. Now, what's really interesting here is the stark, jarring contrast to that strong revenue story we just saw. For the fourth quarter, they reported a loss of 21 cents per share. Okay, but the market was only expecting a loss of 10 cents. That's a 110% miss to the downside. They didn't just miss expectations, they completely shattered them in the wrong direction.
And this isn't a one-off thing. It's not an anomaly. While they have a history of beating on revenue, they also have a very consistent history of missing on earnings. For 4 straight quarters, they have underdelivered on the bottom line. This isn't a growth story anymore, folks. This is a story of overpromising on growth and underdelivering on the only thing that ultimately matters, profit. But the biggest red flag, the one that should make any investor just stop and pause, is this next number.
So the crucial point is this number, an Altman z-score of 0.46. For anyone unfamiliar, the z-score is a formula that predicts the probability of a company going bankrupt. Anything below 1.8 is considered the distress zone. At 0.46, Westrock isn't just in the zone, they are deep in it. This isn't some hairline crack we're talking about. This is a seismic warning about the structural integrity of the entire company. And it's so low precisely because of the issues we've just seen. Persistent losses, eating away at retained earnings, and a huge pile of debt relative to its assets. It signals a real, quantifiable risk of failure.
All right, that z-score is a serious charge. A number that low points directly to major problems on the balance sheet. So to really understand that risk, we have to get our hands dirty and look under the hood. We need to see what is actually holding this company up. Is the financial framework that they've built about to buckle under the strain?
And this right here, this is the core of the entire problem. On one side of the ledger, you have over $900 million in liabilities. That's what the company owes. On the other side, you have negative shareholder equity. Let me be crystal clear about what that means. Shareholder equity is what's left for the owners after you sell every single asset and pay off every single debt. A negative number means that if Westrock liquidated everything today, they still couldn't pay back their lenders. There is literally no book value for the shareholders. It's less than zero. And that brings us to the topic of leverage. The company has a debt-to-equity ratio of 2.08. But frankly, when your equity is negative, this ratio can be really misleading and almost academic. The crucial point is simply that the debt is substantial and the equity base isn't just small, it is negative. This means the lenders have a bigger claim on the company's assets than the owners do. For a company that isn't profitable, this is an incredibly precarious, dangerous position to be in.
So with all of this risk, they're unprofitable, they have massive debt, there's a literal bankruptcy warning flashing, you would expect the stock to be dirt cheap, right? But this is where the story gets even more confusing. When you look at how the market is actually valuing this company, it's sending completely mixed, contradictory signals. It's a real paradox. Exactly. On one hand, you have the price-to-sales ratio, which is down at 0.38, near a 5-year low. This compares the stock price to its revenues. A low number like this suggests that, based purely on its sales, the stock looks undervalued. But then you look at the price-to-book ratio, which is over 33. This compares the stock price to the company's net asset value. A P/B of 33 is astronomically high, especially for a company we just established has a negative book value. It makes no sense.
And this is what that paradox looks like in plain English. This is an official warning from the financial data service guru Focus. It looks cheap based on one metric, sales, but the underlying fundamentals, the actual financial health of the company, are so weak that the value you think you see might be a complete illusion. This is the classic, textbook definition of a value trap. It lures you in looking like a bargain, but the foundation is completely rotten.
Okay, we've laid out the powerful bull case, and it's driven by that incredible revenue growth. We've inspected the deep and, frankly, worrying cracks of the bear case. We've taken a look under the hood at the balance sheet. Now it's time to assemble the final blueprint. After hammering on this company from all sides, what are we actually left with?
On one hand, you have an undeniably powerful growth engine. That 40% revenue increase is real, you can't take that away from them. You have a clear outlook from management for improved earnings and a proven track record of hitting their sales targets. This is the story of a company that is aggressively building for the future. And on the other hand, you have a structure that is fundamentally unsound right now. It is unprofitable, it is drowning in debt, it has negative book value for its owners, and it is carrying a statistical warning of potential bankruptcy. That future growth has to do all of the heavy lifting just to fix the critical existential problems of today. So the final verdict from Iron Financial is one of extreme caution. This is not an investment for the faint of heart. This is a high-risk, high-reward speculation, pure and simple. The bull case requires you to believe, with absolute conviction, that the future growth promised by management will not only materialize, but will be profitable enough to patch these severe foundational cracks before the heavy debt load causes the entire structure to collapse in on itself. And the crucial point is, this is not a solid, durable investment today. It is a bet on a turnaround. It's a bet that they can convert all those sales into real profit before their liabilities catch up to them. For us at Iron Financial, the quantifiable risk of those foundational cracks bringing the whole thing down far, far outweighs the potential of the growth story. It's a trap until they can prove, with real numbers on the bottom line, that they can finally build on a profitable foundation.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.